In this video, we're going to research selling naked puts on SPY the past 10 years, as well as look at how it did during the 2008 financial crisis. We're going to sell far out of the money naked puts as to make it a higher probability trade and use stop loss orders to minimize losses from market pullbacks. And all I ask in return for this video is for you to hit the like button to support independent research on this channel. Keep in mind that everything on this channel is for informational purposes only, and this is not financial advice. All right, let's get started. All right, let's dive into the backtest software and set up this trade. First, we're going to be looking at a 10-year look back. We're going to be selling a put, and we're going to start with the technical open. And what we want to do is we only want to see the results if the market was trading above the 200-day moving average, and that's going to help keep us out of some market pullbacks or bear markets. Over the last 10 years, we've had a couple pretty significant corrections, and we'll come back in here and test a couple different levels here just for fun. But let's go ahead and set that up. And the other thing we're going to do, since we're selling so far out of the money, we're going to be selling a delta 10 put. We're going to set a 300% stop loss on the put option. What that means is whatever the credit we receive for that put option, if the value of that put increases by 300%, we want to close that trade and avoid any really big losses, because remember, when you're selling naked puts, the losses can be significant if the market really goes against you. So we got a couple safeguards in here. Again, we're going to only trade this when the market's above the 200-day moving average, and we're going to have that 300% stop loss. Let's go ahead and type in SPY and we'll get the backtest running. All right, and again, we are trading a naked put. We had a 89.8% win rate. We made about $2,000. The risk here was about what you would need to trade this, how much capital you would need. So it's basing that total return off the risk. We did sell this 30 days to expiration, and we had 97 wins, 11 losses, and made about $2,000 over the past 10 years. I know it doesn't seem like a lot of money, but keep in mind we're just doing one contract and we're trading these sequentially, meaning we sell one put and we're waiting for it to expire worthless. Basically, we have to wait a full 30 days, and we have our safeguards in place. So let's look at the chart of the market the past 10 years. Pretty bullish. We had a couple dips in here. This blue line is the 200-day moving average that we've set. And so for much of the period, the market is above the 200 days, so we'd be trading this pretty often. And we had a few dips here in 2015-16, and then we had a pullback in 2019 that brought us below the 200-day. And obviously, we have the COVID crash of 2020, which brought us down there. Let's look at the P&L curve of the profits over time. You can see it's a little bit choppy. There was a pretty good bull run for a few years, and then we had that pullback. And then from basically 2018 through 2019 was very choppy. You made money, you lost it, you kind of gained it back. And here's that COVID crash. And ultimately the market has recovered and was starting to make money again. So it's a pretty choppy strategy. This is sort of the danger, if you will, of selling far out of the money options, is that when the market goes against you, you can experience big losses. So even though we have a 300% stop loss, the COVID crash really did some damage to this trade. So let's change the moving average around to see if we can, filter out some of these larger trades. So again, keep this in mind. We had a 110 trades or so, 90% win rate. We made about $2,000. So let's go into the technical open and let's change our moving average to the 100-day moving average. That was something that somebody commented on in the previous video where we looked at this with IWM. So I wanted to vary it up a little bit here. So let's save it, and we're only going to take this trade now if the market is above the 100-day moving average as opposed to the 200-day moving average. All right, so we can notice already that we made $3,800 and had 117% return. It actually improved that win rate by up to 93%. Before it was like 90%. So, and we still had pretty similar gains, or a pretty similar number of trades. There's a little bit less trades, but not that much. So we almost doubled the profitability just by changing the moving average. Let's take a look at the chart just so we get an idea. We have the same periods here below the 200, but you have a couple, a few more dips below that 100-day moving average, as you can see. And I think what really maybe save this a little bit is that you got out of the COVID crash early. You're probably going to have one blow up trade. But let's look at that P&L curve. Very interesting. You had a nice bull run. The givebacks were not as much, although you still had a little bit of a range bound profit, meaning you had profit, you lost, got back up, and ultimately made money back moving forward. So the P&L curve is a little bit smoother using that 100-day moving average. So that's something to kind of keep in mind, that sometimes you're so far away from that 200-day moving average that you can pull back. That snapback can be really hurtful, especially when that COVID crashed. So let's do one more thing. I want to test the 50-day moving average. That was another request. And by the way, if you have any recommendations or something interesting you'd like to see tested, put it in the comments below and I'll see what I can do and get it on the next video, or maybe get it on the list of videos I have planned for you guys. Let's go ahead and hit save, and let's see what the 50-day moving average did to the results for selling this 30-day naked Delta 10 put on SPY with a 300% stop loss. All right, so we can see our win rate came down. We still made more than the 200-day moving average, but a little bit less than the 100-day moving average, and we still had a similar number of trades, so 91% gain. Let's take a look at the chart here. You can see the 50-day moving average, although it acts as support, there's a lot of times where it does dip below, and we can see the COVID crash, you got out, very similarly. Let's look at the P&L curve. So this was a little bit choppier, not quite as good as using the 100-day moving average, but again, nice bull run up until mid 2015, had kind of range bound profits, and then again, this period between 2018 through let's call it 2018 for the most part, was really choppy. And if we look at that on the chart, this is a range bound market. So when you're selling insurance, basically, you might end up with range bound profits, especially if you're putting on that stop loss. Now we could test with no stop loss, but obviously that's a little bit riskier, and a lot of people don't want to even see that, but that's something we can do another video. Let me know in the comments if you want to see something like that. But ultimately the strategy made money, and I think going back to the 50-day moving average was actually the best version of this, with at least with these parameters. All right, so we've tested 3 different moving averages. Let's test the 2007-2009 period. So we're going to go ahead and just leave it on the 50-day moving average here, and let's see how this did during the bear market of the financial crisis. Now, keep in mind, the actual main drop-off was actually in 2008, and 2007 was kind of choppy, but you can see it actually didn't do that bad. I mean, considering there was a massive bear market, you were still up during this period about 15%. You made a few $100, 90% win rate, a lot less trades. Obviously, it's not as big of a time period. Let's look at the P&L curve. It's, again, very choppy. You're up a little bit, you're down a little bit, up a little bit. And ultimately, as the market recovered and came out of that in 2009, it started to be a winning strategy again. So let's go ahead and change that moving average to the 100-day moving average, and let's see if that varied the results a little bit. Okay, so similar results, maybe a little bit more profit, 90% win rate. We can see this actually, I guess the P&L curve is a little bit better, but still we're talking just hundreds of dollars here per contract. So ultimately, I think this did a little bit better, so than the 50-day. So the 100-day is kind of beating the 50-day for now. At least you were left profitable during the crash. And remember, these flat lines mean there's no trades and your profitability just kind of flat lines there. Let's go back in and test the 200-day moving average, and let's just see what that did. Because I know a lot of people use that 200-day moving average as a bull market filter, but we're starting to see, at least with SPY, that the 100-day may be a little bit better. So let's see the 200-day, very similar. I'll call it very similar to the 100-day moving average, but ultimately, the idea of using some kind of moving average as a bull market filter. So if you trade bullish strategies like a naked put, and you are selling very high probability trades, so that's going to keep you out of some of these bigger moves. All right, thanks for watching. We'll see you at next week's video.